How to buy low and sell high using simple rebalancing technique. That's our topic for discussion today in the Market Secrets investment series. Before we begin, I have a notification for you. In addition to the investment series, we are running multiple other learning series in parallel on price action trading, algo trading, and trading strategies. Also, we are providing multiple data feeds for our users. So if you are interested in any of it, check out our website www.marketsecrets.in. And with that note, let's jump into today's session. So, how to buy low and sell high using simple rebalancing technique. Rebalancing is a simple technique of adjusting percentage of your holdings of various asset classes. Rebalancing is not an on-time activity and it should be an ongoing process. So we need to maintain the allocation by rebalancing at times. In simple terms, we go to the gym to get fit, shed extra weight. Periodically rebalancing your portfolio is a superb way of staying in shape financially. It helps you to shred excess holdings of various assets you hold over and above your risk tolerance. In order to make a profit on any investment, you must buy low and sell high. Both of these, particularly the former, are extraordinarily difficult to do. Buying low means doing so when the asset has been falling rapidly with the poorest recent returns than the other asset classes, generally accompanied by a negative commentary from the experts. This is as it should be. You don't get low prices any other way. Rebalancing in this period will help you to buy low. Likewise, selling high means just the opposite. The asset has had a high recent returns and is outperforming other investments. It is the general consensus that it is the wave of the future. This is also as it should be. You don't get very high prices in any other way. Rebalancing in this period will help you to sell high. Rebalancing is a simple technique which forces you to buy low and sell high. It takes many years and many cycles of rebalancing before you realize that it is a profitable activity. Another way of putting this is that rebalancing forces you to be a contrarian, someone who does the opposite of what everyone else is doing. Financial contrarians tend to be wealthier than the folks who like to simply follow the crowd. This concept also reveals the major benefit of a diversified portfolio, the advantage of making small bets with dry powder. We have talked about the small bets and dry powder in the earlier episodes of the investment series. So look at those if you don't understand what it is. If you have a properly diversified portfolio, you are in effect making many small bets, none of which would ruin you if they go bad. That's how you win the long game of investing. It is often said that the small investor is at an unfair disadvantage to the professional because of the latest superior information and trading ability. This is certainly true for trading in individual stocks. It is even more true in the trading of futures and options where more than 90% of the small traders lose money. But when it comes to investing in the entire asset classes, it is really the small investors who possess an unfair advantage. You may ask how and why. As a small investor, you only have your own gut reactions to worry about. The mutual fund manager, on the other hand, constantly has to worry about emotions of his clients who likely will be annoyed with the purchase of poorly performing asset classes. For example, if a fund manager buys stocks when the market is crashing, people will thrash him. In such a situation, rebalancing into poorly performing asset class may be an impossibility for a mutual fund manager. They will be questioned if they invest in stocks when the market is falling, which is in fact the right thing to do. Successful investing is like driving the wrong way up on a one-way street. This is difficult enough with your own vehicle, but nearly impossible when you are doing it in a borrowed Rolls-Royce car whose owner is in the back seat screaming at you at every potential collision. That's the pressure mutual fund manager has to handle if he invests in stocks during market crashes. But as an individual investor, you only have your own gut reactions to worry about. So if you can control your emotions, no one can question you if you invest on the stocks when the market is crashing. So that's the advantage a small investor has when it comes to investing. So the most important question now, how often you should rebalance? The question of how often to rebalance is one of the most common ones in investing. Most people go for quarterly or half-yearly rebalancing, which is too frequent. I would say once in a year or once in 2 years is even fine. Other option is go for tactical asset allocation. With tactical asset allocation, we can rebalance if any asset class deviates from the asset allocation by certain percentage. But please do consider taxation in mind while rebalancing. If it is done properly by combining it with tax harvesting, we can in fact reduce the taxes greatly. So with that note, we have come to end of today's episode. I hope by now you would have understood how to buy low and sell high using a simple rebalancing technique based on asset allocation. If you have any queries, comments, or feedback about this episode, please leave it down in the comment section. I'll be happy to answer and address it. So, how often do you rebalance? And have you ever experienced this phenomenon of buy low and sell high using the rebalancing technique? Let us know in the comment section. Also, hit the like button if you have liked this video and share it with your friends if you find it useful. Also, subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.